Things that you mentioned in passing there, John, was there's been this, when you have dishonesty or fraud in the physical market, you get this artificial elastic expansion of apparent supply, which can absorb more and more investors' funds. You talked about this over a year ago about pool and unallocated accounts. If they can just keep, you can keep investing, and they keep absorbing more and more fiat in investments from investors and claiming, don't worry, you've got there's some metal under there somewhere. But as you point out, that when it really comes to be crunch time and it's time to show what you've actually got and actually account for it through an audit, that when it's discovered, if it's discovered, that there's much less actual physical than has been previously claimed, and there'll be some, all this finger pointing and irregularity. Who knows what'll come, but when that realization hits that there's much less physical than was previously assumed, then that implies all of these funds that have been absorbed elastically into this fictitious pool of metals are now has to be accommodated by the actual much smaller physical pool. That's where I think, if I'm understanding correctly, you're saying the natural consequence of that, just due to the laws of nature, is that the price would have to go up to accommodate for that.
Yeah, so obviously, if there is a lot less physical supply, physical supply in the physical market, that obviously will have implications in terms of what would happen in London, what would happen in New York with the COMEX, etc. And I have to say, Dunnigan, that and I'm going to write an extensive article about this later in the year, but just to sort of foreshadow what I'm about to write about this topic is, so I think this issue is fundamentally a potential revolution in the way people should think about the market. So let me give an example. A lot of analysts have a very basic understanding of how this process works. Central bank prints money, devalues the currency, causes inflation. People try to seek refuge from inflation, buy precious metals. That creates investment demand, and that investment demand will ultimately lead to a rise in price. Now, for example, the Silver Institute only in the last, I think, month, said that 2021 was a record for investment demand, and they are foreshadowing that 2022 will be a record for global investment demand in the history of modern-day silver. And yet they are still forecasting the price to go lower rather than higher. So that makes no sense. So I've started to think that if any analyst thinks that demand is driving the market, I don't think that's true. And I think I'm going to come to the conclusion that it's actually investment supply that really moves the market. So obviously, if you have infinite amount of not only just paper silver, but the illusion of physical silver that doesn't exist. If you can just create that through fractional reserve schemes and fraud and in terms of rig orders, etc. Well, I mean, that ultimately is going to influence the market much more. So, for example, you could have an extra $5 billion of a new investment demand coming in, but if there's no physical, if the investors think that it's backed by physical, but in reality there's no physical, well, investment demand has basically an immaterial effect on the market. And that's why I think what we're going to see as we go forward, as more issues come out in the physical market, we're going to learn that it's actually investment supply that actually drives the market more than investment demand. And it's really the transparency and truth of the physical market that's ultimately going to be the determining factor as to what sort of price point we get and what sort of rate of return that investors will see in terms of whether it's a physical gold and silver in terms of mining stocks. Now, I have to say, and to be quite honest with this, I mean, this causes a dilemma for both you and me. So you work for Miles Franklin, I work with As Good as Gold Australia, and part of our remuneration that we earn personally is by facilitating the purchasing of precious metals. And so there is a natural incentive for analysts who are linked to bullion dealerships, and a lot of the YouTube commentators do get some remuneration from bullion dealerships in one form or another, or from mining companies. We have a natural financial incentive to promote demand, because that's how we personally get paid. But in reality, so 12 months ago, I really believed, and obviously as an economist, it makes sense that more investment demand is going to lead to higher price. I mean that in a free and fair market, that's quite plausible and it's quite reasonable. But given that we're talking about a severely manipulated market, even though it's necessarily not in my personal financial interest to basically say this, I think investment demand is not really what's driving the market. And even if we got more retail investors to buy more gold and silver, I think that's immaterial. What really is material is investment supply, the real state of the physical market in terms of how many ounces actually exist, and actually getting more truth and transparency right throughout the supply chain, so that we clearly know exactly, in terms of what's out there. I think David Morgan has said that in his view, there are, sometimes it could be 50 claims, 100 claims per ounce of in terms of real silver that exists in the global market. And so it's all about exposing to the eyes of investors that what they think they own, they don't own, and that they should actually readjust their investment decision so that they can actually get physical silver or physical gold, that they know for sure that it actually exists. And that's where our campaign March of last year about unallocated, pool allocated was so essential, because the thesis I put to you at that point was that if every investor at the retail level in unallocated, pool allocated liquidated those positions where there's counterparty risk and they don't actually legally own anything, and they switch it over to a physical ounce, that in and of itself should basically put a lot of pressure on the physical market, and that obviously would lead to the sort of phenomena about putting pressure on COMEX and derivatives market, as we were just saying earlier in terms of this interview.